Right now is Federated Advisor Senior Portfolio Manager R.J. Gallo and RBS Chief U.S. Economist Michelle Girard. Good to see you both. Thanks so much for joining us. Michelle, let me kick this off with you. Are you expecting any news out of the Fed today?
Well, no. Nobody's expecting any action today. So for the Fed to surprise us with a rate hike would be really uncharacteristic. But of course, we're going to look so closely at what the Fed and what Janet Yellen says in her press conference. Are they going to stay on this path of continuing to gradually raise rates? They had indicated in December that they thought moving rates up maybe 25 basis points a quarter at every meeting that we see where she gives a press conference was appropriate. And because of everything that happened in the markets in January and February, I think they want to wait and make sure the U.S. economy is okay. But I think her message today is we've come through it pretty well, and more or less we're still going to be on that path of gradually nudging rates higher.
But not today. R.J. Gallo, have you done anything different in your portfolio as a result of what you're expecting from the Federal Reserve? Do you agree with Michelle?
Yes, I do. I don't expect any Fed tightening today. I do think they'll reassert that the U.S. economy is on a moderate growth path, and some of the fears about sharply negative financial conditions that occurred in January have ebbed. Inflation expectations, actual inflation, both have started to perk up in the direction that Janet Yellen and others on the Fed had expected. And as a result, I think they will continue to nudge in this gradual normalization trajectory that they started way back at the taper tantrum back in 2013. In terms of portfolio positioning, shorter-term 2 to 5 year securities are probably more vulnerable from a valuation standpoint. They've already moved a bit as Fed expectations have increased from early February, but we think there's more room to go with 1 or 2 tightenings to come this calendar year. Certainly not at this meeting, however.
I see.
You've got the rest of the world in possibly a negative rate position, and if you were Chairman Yellen, would that worry you? If you're, and you've got that tug of war on the Fed.
Right.
Fisher wants to go up, Brainerd wants to go down,
right.
So, and she's getting pulled in 2 different directions. So what would you do?
Well, I tell you, that's the whole question: is how much is the international situation supposed to factor in to the Fed's decision? And I think, more or less, as long as we're seeing the U.S. economy holding up well, and as long as we see the U.S. fundamentals suggesting that, hey, at 25 to 50 basis points, rates at this low don't make sense for the U.S., I think that the Fed has to sort of continue on the path that makes the most sense with what's going on here, taking into account what's going on globally, of course. But, it's not clear if the Fed does less and deviates that actually helps the overseas situation. Remember, one of the avenues that these global central banks, they're going negative. They're taking rates lower overseas so they can weaken their currency. They can borrow a little growth from the U.S. If the Fed doesn't do anything, it puts more pressure on them to have to go more negative.
So the policy is make the dollar great again. Is she going to get hats to say make the dollar great again?
Well,
is that what's going to happen?
But you know what? A lot already. We've seen the dollar move up. We've seen the undermining of manufacturing activity. There's no question that adjustment has taken place, and we've given some growth to the global economy. Ultimately, though, we have to remember the Fed thinks about it a little longer term and saying if ultimately global growth picks up, we will see the benefit of stronger export growth. I mean, we're all better served. We don't want to give all our U.S. growth away overseas, clearly. But if we can, if the overseas economies do better, that in the longer run does come back to help our exports as well.
Mm-hmm.
I wanted to ask you, though, Michelle, retail sales last month and then lowered again for January. Like, doesn't that give the Fed pause? Doesn't it give you pause in terms of the strength of the consumer?
Down 0.1%.
Right.
But there was a big downward revision to January, but then December actually was revised up a lot. So on net, we weren't as weak as it initially looked when I saw that print. I also think it's interesting, though, to the good. Consumer confidence has held up pretty well given all that we've seen this year. Consumers are spending on, and we talk about areas they don't have to, like restaurants. I mean,
and
cars. So honestly, I think you're right that we've kind of had this 1 month better, 1 month worse. The consumer's not taking off. On the other hand, the consumer, I think, has held up very well in the face of all the increase in uncertainty that we've seen since the start. I think a big reason for that is the low energy prices.
RJ, what about that, the energy story? I mean, at $36 a barrel, it's looking pretty good based on what we saw earlier in the year. With that, recession fears have begun to fade. What do you do with the portfolio this year? Do you want to buy stocks here or not?
Well, I would say that within Federated, within the fixed income side, sort of my home base, we remain overweight more economically sensitive assets. So, for example, high-yield corporate bonds, which as recently as 3 or 4 weeks ago seemed as if they were almost radioactive to some, have bounced sharply. Of course, the recovery in value there is accompanied by the sharp recovery in equities as well. In Federated fixed income, our base case is that we are not headed towards recession. The recession risk that was pretty popular in terms of discussions a couple of weeks ago.
Yeah.
We understand the discussions. We don't think that's the base case. So we like assets that are economically sensitive. Valuations have improved a lot. They still have a little bit more room to run.